Carter Braxton-Worth, head of technical analysis at Cornerstone Macro. Carter, good to see you. So you had a report earlier, 145 in the cards. Walk us through what you're seeing.
Sure. So we know that, well, let's start with this, actually, and I think everyone would agree. Is there any really important difference between 145 and 125, 155 and 115? The 10-year cost of money is cheap. And I think the great irony is that doing one's 3 to 5 year DCF work and trying to figure out what a great growth company is worth doesn't and shouldn't change whether interest rates are 145 or 155 or 125. But somehow, money seems to take big interest in that. Yes, if we had rates moving into the 3s and 4s, you have to consider that. But what we do know is that interest rates have been in a well-defined down channel or trend, if you will, since the peak, 5-6 months ago in March at 177. And interest rates bottomed and now have breached the upper band of that channel. And that's a pretty important development. And what we're thinking here is that we're ultimately going to get to 145, the number you referenced, Melissa, because not only is it exactly a 50% retracement from the peak of 177 to 113, but it's also where the 150-day moving average is, something I rely on heavily.
So, Carter, when you take a look at these charts in terms of where yields are going, I mean, the trade in the financials, for instance, have shadowed where yields go in large part for many, many months now. And I'm wondering if the charts sort of line up in the technical analysis.
Well, in the sense that, again, it's all about who you are in the market and what your time frame is. Surely if rates do start to inch up to 155, let's say, or 16, financials get a bit of a boost, an interest. But here too, I mean, if you think of the long term, if you look at financial, we might have a chart here of of the sector since 1989 GICS data. Now, Joe, you'll remember that when we started, I think you were probably at Merrill, before 1989, the sector nomenclature was different. They didn't call it consumer discretion and consumer staples. It was consumer durables and non-durables and things like that. So what's interesting is that now, as we have it, the relative performance of financials, the sector as we know it now, is actually remarkably back to its '09 low relative to the market. I just don't think it's a good area to be in.
And I also wanted to ask you, while we have you, Carter, about the breakout that we've seen, or I don't want to say breakout, but snapback rally, shall I say, in oil, and what you're seeing in oil and energy stocks.
Yeah, that too. I mean, this is, how would I say it? It imputes to the person trying to do it such an ability to time that I don't think it's worth the headache. One, it's too small an area of the market now. There were great leather companies and cord and twine companies and tin companies in the Dow Jones Industrial, radiator companies. Coal. Oil is just too small an area of the market, one, for a benchmark manager, two, at less than 3%. Two, in the past 6 years, it's had 2 periods where it's generated alpha to the S&P, a 4-month period and a 3-month period. This entire move this year, relative to the market, it was October low to March high. You had basically 5 months. I don't like energy. I think it's a hard game, and I don't think one needs to do it.